Good morning, Mr. Brendan McCracken. Thank you very much for doing this. I appreciate your time.
Yeah, happy to be here, Trevor. Thanks for the invitation to join you.
I know your time is valuable, but the audience will really appreciate it.
Yeah, great.
You are the CEO of Ovintiv, but for the listener, you are also a pretty interesting person. If I'm correct, you're a skier slash biker slash surfer, big supporter of the Philharmonic too.
That's right. Yeah, that's right. I used to be on the board of the Calgary Philharmonic, and yeah, definitely love spending time in the outdoors.
Have you been out skiing yet this year?
I have not. I have not yet. Yeah, hopefully soon. But yeah, we just got through our quarters, so yeah, hopefully as the snow starts to accumulate, we'll get a chance.
To start from the top, like we said, you are the CEO of Ovintiv, but to get it from the source, what is Ovintiv?
Yeah. Well, I think first of all, like I said, really pleased to be here and humbled always to have the chance to lead this great company and to get to represent it. So Ovintiv, we make modern life possible. We produce almost 600,000 BOEs a day of oil, gas, and NGLs from 4 different basins. So we're in the Permian in West Texas, the Anadarko Basin in Oklahoma, the Uinta Basin in Utah, and then the Montney in Canada. And the way we think about our business is our products fuel the world. The company's been around for some 140 years, and we are super excited about the business that we have built today. And I'm sure we'll get into it, but we've worked really hard to set up a business that can generate durable returns in excess of our peers and in excess of the S&P. And we've built a strategy around doing that centers on building a deep premium inventory of what we call premium return drilling locations. We've created one of the most innovative teams in the industry with a proven track record of operational excellence. And our team is just knocking the cover off the ball in 2023 here, and we've been on a real roll with a series of accomplishments.
How did you get into energy? If I'm correct, you're an engineer by training from a small town in Ontario?
Yeah, that's right. You got it. Look, I'm a farm kid from Southern Ontario. I got the chance to be exposed to the hard work and the decision making required to run a thriving business from a very early age in that environment. And when I wound up in an engineering school at Queen's, I took a summer job with an oil and gas company called Pan Canadian. And that, through a whole series of combinations and different name changes and different roles and responsibilities, has led to Ovintiv and led to the role that I have today. But yeah, it was, I think there's a natural synergy between agriculture and energy production. Commodity-based businesses, operational efficiency matters a ton, strategy matters a ton, capital allocation, very important. And so in a lot of ways, the early experiences that I had growing up on the farm had a preparatory element to oil and gas and a natural fit with the energy business.
Statistically, nowadays, the odds of staying with one company your entire career are very low.
Yeah.
Also, being an engineer, rising to the top of a multi-billion-dollar organization as CEO, the odds of that are very low. What do you think led to you down that path? How come you ended up where you are now?
Yeah. I mean, it's a great question. I wish I knew precisely. I don't think there's ever a formula or a exact answer to those types of things. But I think for me, my parents and my grandparents were extraordinarily influential early on and inspiring. And one of the stories that I think a lot about is my grandfather. When he was 16, he got a chance to go to the World's Fair in Chicago in 1933, and that kicked off a lifetime of curiosity and entrepreneurism and travel for him. And it's interesting, the echo of that experience through the generations, and that sort of thirst for opportunity and creation of opportunity really had an imprint on me. And so I think those experiences left that indelible mark. And, you know, growing up in the farm business, I got to see how operational capability could make a huge difference. You know, consistent execution, no shortcuts, working safely, investing in technology could make a big difference to the bottom line. And so, you know, when I wound up starting in the oil and gas business, you know, a lot of those things seemed to fit for me. And you know, I wound up following a career path that had a lot of breadth in it. You know, required a lot of versatility. You know, one of the things that I really enjoy is getting a chance to lead all the way from the rig floor to the boardroom, and being able to connect with people in all of those different environments, and you know, create common cause and work towards those goals together is a really enjoyable part of what I do. And I think that's been something that's served me well over the years.
Coming from a farm background, how important do you think it is to be able to speak field, so to speak?
Yeah, I mean, I don't know that you have to come from a rural or farm background to do that. And certainly there's many successful leaders that are equally versatile.
Mhm.
But I think, you know, just being curious and interested, and, you know, what fills me up in my job today and for a long time, what's filled me up is seeing other people succeed and watching them do things they didn't think they were even capable of. You know, it's like the Bam Bam from the Flintstones. You know, they don't know their own strength, and seeing teams, you know, work their way through problems and find solutions that we would have never imagined, you know, coming into the experience. That's the fun stuff. And we do that every day in the field. We do it every day in the boardroom, and that's the enjoyable piece. So in a lot of ways, building trust and that open line of communication is sort of a natural thing to do, but really important to be able to connect with all those audiences.
Well, I thought today, for the purposes of this conversation, we could loosely structure it around a curious investor.
Sure.
Maybe we could start with a bit of macro and get into Ovintiv a little bit.
Sure.
In terms of high level, the industry seems to be entering an M&A phase in Canada, maybe a little bit in the US. And I know you can't talk about it much in terms of Ovintiv, but from your perspective, is this a good thing or a bad thing? What are your thoughts on it?
Yeah, well, I think, you know, look, it's a really interesting time from a macro perspective. You know, we're obviously in a very dynamic world with a lot of cross currents. And at the same time as that dynamism is unfolding across the broader economy and in a geopolitical and geosecurity sense, we've also had an energy industry that's undergone a pretty significant transformation. You know, and if we wind the tape back, you know, a decade, the industry was in a place where it was creating value through growth. And the idea was to grow your top line, and then, you know, eventually that would pull through to the bottom line growth. And the industry behaved in that fashion for quite a number of years. And then a variety of circumstances has created a shift in that model to today, where the industry is pursuing value through returns. And you know, that shift has unfolded over a period of years, but it's been sort of the period of years that I came of age in leadership in the industry. And so for me, that's kind of the normal, but it has been a shift. And so what that's meant is, you know, a more rigorous look at capital allocation from a return generation perspective means, you know, we run these businesses for free cash flow, and that free cash flow is being deployed to generate more value, either through direct returns to the shareholder or disciplined reinvestment back into the business. And I think that, combined with the dynamics in the world we're seeing, has resulted in a situation where, on a long-term trajectory, the industry has not been reinvesting in itself at a replenishment rate. And generally, the way I like to describe this is it's pretty inarguable that over the last few years, the industry is consuming more inventory than it is replacing. And so we identified that dynamic a number of years ago, and we decided to swim against that tide and actually build inventory at a time when the industry was depleting inventory, because we thought that was going to be a really powerful and valuable feature to have in the business in the coming decades. And I think, over the last couple of years, we've seen that definitely play out. And so you mentioned the M&A piece. I think that is a driver of much of the consolidation that we're seeing, where the industry has sort of woken up to this idea that each company needs to refill the hopper, and it hasn't been organically investing to do that. And so you're seeing it happen inorganically. And so I think that's been a key feature of each of the transactions that we've seen unfold through this year, but even stretching back into last year too.
One analogy that makes sense to me is filling the warehouse full of widgets, where you're stacking inventory, and the idea is that you need to be able to last, so to speak. But one concern of that comes from investors is that you're doing the deals correctly, where hopefully you're not issuing too much equity and you're really treating the shareholders right. Certain deals haven't been rewarded on deal day in the last month or so. How do you ensure that investors are confident in the deals that you do?
Yeah, I think that's a super important piece here, right? Is any of those transactions, anytime you're allocating capital, you have to manage risk and ensure that the accretion that you're hinging the deal on is real, and that investors are going to recognize that, and that you're going to be able to deliver on it ultimately. And where we start is we hang everything off of strategy. So I talked about our sort of view of how inventory is becoming more and more valuable in the industry today. But really how we arrived at that view was in the course of formulating strategy. And it's something, I dedicate quite a bit of my time, allocate time to that, because I think it's just super important. And out of that falls the decision-making around how to allocate capital and how to structure the deal, and whether a given combination is a good deal or a bad deal. And, so in our way we run the business, we hang everything off of strategy. So whether that's how we're organized, the process that we follow, the culture that we're creating, to how we actually make decisions in the business. And, the tagline for our strategy is durable returns. And the idea is that instantaneous returns, whether that's the return on the capital we invest or whether that's the cash return we're delivering to the shareholders, instantaneous returns are interesting, but what's really valuable to investors are durable returns, to be able to deliver those leading and superior returns over a long period of time. And we've created a 3-part recipe for durable returns. And the first list on that, a first ingredient in that recipe, if you will, starts with the rocks. So this idea that in order to deliver that superior return, we have to have the resource and the inventory that's at the low end of the supply cost curve, which means it's also at the high end of the return curve. And, there's nothing more pivotal in our business than that access to great rock. It is ultimately the hurdle that you have to clear in order for the other 2 ingredients to even matter. And over the course of our industry's history, there's always been a rotation of play types where different play types assume the leadership role of that supply cost curve and return generation. And shale is, in particular, the North American shale, has occupied the leadership role for quite some time now, actually a historically long run. And so one of the things that we spend quite a bit of time on is we call it a global resource assessment. And we actually zero in on North America in that resource assessment. That's where our expertise is. It's also where our kind of unique private data set is. And we take a very deep look at what that North American resource is going to look like over decades. We essentially simulate a variety of scenarios of future development of every basin in North America. And what that gives us, one of the things it gives us is a really clear picture of where the remaining premium resource is, where those high return inventory locations are. And so that's kind of the job one of our strategy formulation, is identifying those resources. And then the next part that we've been enacting on over the last several years is going out and capturing those, and both organically with an appraisal and assessment program where we spend about 10% of our capital into that organic effort to add inventory, and then through a series of bolt-on transactions. And then earlier this year we did a larger transaction to bolster that inventory position for us, and like I said, really swim strongly against the tide that the rest of the industry is experiencing.
Some sophisticated investors understand the energy industry and may get deals immediately when they're announced, but also there are chunks of the investor base that maybe don't understand the nature of the oil that may or may not be there. Is there a tension at times explaining to the investor base what deal you've just done so that your stock doesn't get hammered on deal day? Do you find there's a bit of tension there?
Well, I mean, look, our experience was overwhelmingly positive in this space. So, we did a larger transaction earlier this year where we added over $4 billion worth of resource, 800 plus locations in the Permian, and stock went up, 12% on the day. So, I think, to answer in the positive, I think, outlining for shareholders how it was accretive on a per share basis, both the cash flow per share and free cash flow per share, how it was accretive on an inventory basis, how it was a strategic fit for us from an operational execution and synergy perspective. I think we're all really important to driving that, and then driving the performance of the equity since. I would argue the investors that we interact with, and we interact to our investors quite frequently, quite sophisticated on all of this, very, very in tune with our strategy, but also in tune with what's going on in the broader industry, even amongst the generalists who, by necessity have to cover multiple industries. I think a strongly sophisticated view of what's unfolding in the sector, and that's encouraging because I think in order for Ovintiv and the rest of the industry to continue to realize a valuation more commensurate with our earnings, I think that that sophistication is needed, and an understanding that the industry is, there is a price dislocation there and a value opportunity. I think we see the green shoots of that today.
Are you seeing a renewed interest in the sector from the generalists nowadays? Is it coming back?
Yeah, for sure. And I think, you look at our shareholder list today as the strongest it's been in my kind of living memory, in terms of, high quality, long only shareholders that are buying into what we're our strategy and our execution against that. And so I think that's a good signal. I think we're seeing things deeper into the capital structure that are interesting too. So family offices have really switched on to energy. And that's a really interesting, I think we call it a canary indicator, where a lot of those family offices created enormous wealth over the last couple of decades in other sectors, right? They generally weren't investing into energy. And I think there's a bit of a vanguard there where we're seeing those family offices put money to work directly into the energy industry because they now see a value dislocation opportunity that they're excited about. And I think that is going to continue to drag, other larger public institutional money into the sector as well.
Again, getting back to the concerns from investors sometimes is that all it takes is one decision from OPEC to erase the margin from the business. Is there much explaining you need to do on that end? And how do you structure Ovintiv so that you're guarded against that?
Yeah, for sure. And that's why we spend so much time focusing on that strategy to have the lowest supply cost. Because ultimately, we live in a volatile commodity industry. Like you said, there's externalities that we don't control, and in fact are even sometimes hard to anticipate. And so we have to have a business that runs at a very low break even, so that you can be. I always think about there's sort of three bins of companies, right? You can have a vulnerable business that's susceptible to external shock, and everybody understands why you wouldn't want to have that. You could have a resilient business that can withstand those external shocks, and then you can have an anti-fragile business that actually can be opportunistic in a down cycle environment. And we've seen over the course of our industry, that's when real massive value creation can happen. And so the way we actualize that is by making sure we're driving that break even low in the business, which starts with the rocks, and then follows through with how we execute and the capital efficiency of how we run the business.
Speaking of being anti-fragile, it's before your time, but May of 2008, the Encana Ovintiv share was around $250 a share. If you fast forward to January 2016, it was around $30. What lessons have you learned from that experience? Although it was before your time and it is a commodity with a lot of things already out of your control, what have you learned from those experiences to make the company anti-fragile?
Yeah. Well, and I was around for those things. I was in obviously junior roles in the company, but I think the way I really frame this is, if you wind the tape back a decade ago, which is an interesting pivotal time both for the industry and the company, one of the things that we realized about Encana at that time was our portfolio wasn't set up to be successful for the future that we envisioned. And so, I talked about that North American resource assessment work that we do, and we did that work at that time as well. And what we saw was we had a very strong view a decade ago that it was going to be a decade for oil, not for natural gas. And the real reason for that fundamentally was that there was just an abundance of natural gas in North America. At that time, you had the Marcellus emerging, you had the Haynesville emerging, you had the Montney emerging. And so we were really right about that. That was a knowable thing with good analysis and foresight. That was a knowable thing. Now, it wasn't always a great day for oil over that decade, right? I think we had one day where it was like -34, right? So it wasn't that it was always a great day for oil, but it was generally a much better commodity than gas over the last decade. And so when we looked at our business at that time, we had a portfolio that needed a lot of shifting to be successful, because we had a portfolio that was dominated by Rockies gas. And so we undertook a years and years long mission to transform the portfolio of the business and modernize it for what we saw was going to be successful go forward. And so that resulted in a whole series of divestitures where we exited a number of those Rockies gas positions. And then we entered the Permian and we entered the Eagle Ford, and sort of reset the business in a more balanced commodity environment and reset it into basins that were going to be able to compete for capital and be at the low end of that supply cost curve. And really the only asset that's left out of that transition is Montney. Which is probably where I was. I'd have to kind of do the math to figure out 2008, but I think that's where I was back in 2008. And so today, the interesting thing today is to say, okay, well, that's interesting. That's history. What about the future? And one of the, really interesting things about the setup today is same work, same ability to be predictive. So it's not perfect, but I think you can get the themes right if you do the work properly. We think it's actually hard to make a case between gas and oil on the next decade to come. I think there's equal upside in both commodities. Obviously, there's risks in both, idiosyncratic risks associated with both commodities. But we think that actually the rational strategy today is to have options in both, to have high return inventory in both gas and oil. And so, in contrast to a decade ago, when the answer of that strategic look was deeply inconvenient, now today the answer to that strategic view is deeply convenient for the portfolio that we've built, because we've got an enormous and deep inventory of high quality oil locations, and then we have a huge and high quality, high return inventory on the gas side. And so we think we've now really set the business up to be in a place where we can create that value for our shareholders in the coming years and decades to come, because of that platform is now much more well suited to the environment we expect to see.
As a company with assets across North America, are you seeing better opportunities in certain basins and certain places? Maybe you can't talk about it, but is there one that perks your interest more than the others?
Well, we've narrowed it down to 4 very purposefully. When we do that North American resource assessment, one of the things this is the trivia part of the call here, so I'm going to put you on the spot, Trevor. So, what do you think? What asset or what basin do you think has the most industry-wide, not just Ovintiv, but industry-wide, the most remaining oil locations to drill that are high return, would meet what we would call a premium threshold? It's not a trick question on the first one. So,
well, I just want to preface this answer with, I am by no means an industry expert or something that should be listened to in any regard with financial advice, but if I was to follow the experts or the top people in the field from maybe Tourmaline or somewhere like that, Mr. Mike Rose, maybe it would be in the Montney or Deep Basin somewhere, but that would just be off the cuff.
Well, you actually do better than most people here. So the biggest on our numbers, the biggest remaining oil resource in North America is the Permian. And so which kind of goes around with the sort of scale and acreage footprint of that play today. And I think that's a reasonably consensus view. I think most people would sort of say North America wide, biggest oil remaining inventory is the Permian. The one where most people get it wrong, even industry people, is what's the second biggest. And that's the one you hit, which is the Montney for oil. And
yeah,
most people know it's the biggest remaining resource for gas.
Right.
But most people don't realize it's the second biggest one for oil. So, if you look at how we've positioned ourselves, we've got a huge franchise asset in the heart of the Midland Basin in the Permian. We added to that this year in a meaningful way, essentially doubled our oil production and our inventory in the Permian. We've got a huge asset in the Montney, both in the gas and the oil window. And then we have a massive free cash generating asset in Oklahoma in the Anadarko Basin.
Yeah.
That one's interesting because the way our production sets up there, we make about a third oil, a third gas, and a third NGL for every BOE we produce. So it's got enormous commodity flexibility in that basin, and very low declines in comparison to the other basins. So we've ground our Anadarko decline down to 20%, which is, the team's just done a terrific job there. And then we have a really interesting emerging option in the Uinta Basin in Utah, where we have 130,000 net acres in the emerging shale play there, set out over the last 2 years to prove up market access. So we now sell about 40% of our production there down to the Gulf Coast, which means the margins we're realizing in Utah are the same as our Permian margin. So it's highly profitable. And then the well productivity has been tremendous as well. So some of the highest well productivity in North America today is happening in the Uinta Basin. So pretty excited about all four of those basins. It's kind of like choosing like which is your favorite child. You like them all. So
When you look at the chessboard, so to speak, sometimes it's not easy. It's not hard to identify maybe where the most resource is, but the challenging thing is to get it out at a good cost and create value for your shareholders. What do you think the best mechanism is for that? Is it just good geology, or do you think it's strategic M&A, or a bit of both? How do you think about that?
yeah, well, I mean, I love the question because that goes right to the second ingredient of our strategy for durable return. So if the first ingredient is this idea you got to capture the rocks, the second ingredient is the culture and expertise that allow you to convert that resource to free cash flow at a really high rate of return. And what I find endlessly interesting about our business, and I love benchmarking our business against other industries, and to actually try and spend a fair bit of time with other CEOs in other sectors to gain context and insight. But one of the things that jumps out of our business is there's almost no intellectual property, right?
Yeah.
There's basically no trade secrets. We generally use very similar service providers across peers or competitors, and then anytime one of us come up with something new, we put it in our investor relations deck and tell everybody about it. Right? So there's no IP. It's very capital intense, right? If we stop investing, declines are 30-35% year over year. So it's a high capital intensity business. It's extremely unconcentrated. I think actually the only industry in the world that's more unconcentrated than oil and gas is agriculture. So there's a lot of players on the field. Even after round of consolidation, there's still a lot of players on the field here. Even Exxon is less than 2% of global supply. But yet if we look across all the peers, even if we look across like a high graded peer group of admired peers that are great companies, there is a wide range of return on invested capital outcomes.
Yeah, exactly.
So there's a big dispersion in performance, and it actually is not intuitive, right? There's no IP, you can kind of look across the lease line and see what each other are doing, and there's a lot of you to kind of learn from. You'd think there would be more convergence there, and the explanation that we've arrived at is that it's culture and expertise that drive that. And so it's how our team works together. It's how knowledge moves around the organization. It's the incentive to solve problems and innovate that drive that dispersion in performance and can drive that top quartile return outcome. And that's really cool. Like as a leader, that is really a fun place to experiment and work in and create that performance, because we don't have to invest capital to outperform, right? We don't have to do that. We just have to do a great job of creating and building culture that drives that capital efficiency and return outcome.
Most people would look to you for advice at Ovintiv and maybe in the industry in general, but is there anyone you look towards to maybe learn on that, how to run a good company and culture and what makes a top company?
Yeah, I think, for sure. My kind of approach to any of this stuff, whether it's problem solving or culture building, is all about input, and kind of like to think about myself as a bit of an omnivore for input. And so, yeah, I've been really fortunate. And one of the things that's, probably a hidden feature to these jobs is access. It's actually surprising the amount of access that I can manage to get with other CEOs. And so I take full advantage of that. I mean, Jim Umpleby at Caterpillar runs Caterpillar, is a huge mentor for me. One of our investors actually set the two of us up and said, "Hey, I think the two of you should know each other, and I think you get a lot out of it." And Jim, for years, has been somebody that I enjoy visiting with and asking, like, "Hey, how do you think about these strategic problem sets in your business, and how are you solving them?" Translating that for us is really powerful. You know, Henry Kravis at KKR is a really interesting guy to talk about managing risk and innovation, technology. Just incredible how switched on Henry is, and they're in a million different industries, so he has a really great broad perspective. Guys like Dave McLennan at Cargill, from an operations leadership, pretty unparalleled. And so, yeah, I kind of deliberately try and cultivate some of those relationships and learnings. I think before we jumped in, guys like Ian Dundas at Enerplus have been a great mentor, and Mike Rose has been. I think I cold called Mike Rose like 15 years ago and arranged a coffee with him, and he's been generous with his time ever since.
Independent thinking. The idea is to be unconventionally right. In the words of Howard Marks, everybody wants to be friends with the CEO, and usually that's a good idea, but sometimes those relationships come with a fee or biased advice. How do you keep yourself insulated to make sure you're making quality independent decisions in a pretty tight-knit industry?
Yeah, well, I mean, we just talked about mentors, and definitely one of the great mentors I spent a lot of my career working underneath was a guy named Mike McAllister, who's now on the board of ARC Resources. And one of the things Mike taught me really early on is you need to hear the truth from everybody that you're surrounded by, and you can't put yourself in a position where people won't tell you what they think you want to hear.
Yeah.
Because that'll leave you blind, and miss risk, and probably miss opportunity too. And so, yeah, that's something that really left an impression on me from the early days, and so, yeah, we work that really hard to try and scrub out that, whether conscious or unconscious, bias in the input that we're getting as a leadership team here and as a board. And so I think that applies both internally and externally, right? Is be aware of everyone's motives and try and build really high trust relationships that let that candid feedback flow through.
Do you find it takes a lot of evaluation and thinking to get to high quality answers? Do you find yourself having to kind of stress test your decisions along the way as CEO?
Oh, for sure. Yeah, for sure. I mean, if you take the decision we took earlier this year to do the transaction in the Permian, where we bought a little over $4 billion worth of Permian resource and production, and then we sold a little under $1 billion worth of Bakken asset that we really liked, and was generating good free cash flow for us in our portfolio. And so that was a very deliberative, disciplined process that led us to that outcome. We worked strategy, like I said, very hard over a period of years, so that we had really high clarity on how to execute within that strategy. And we did this part of the story, I think, always surprises people a little bit, but we did over 200 smaller transactions in the years leading up to that, and those 200 transactions were enormously accretive, created a lot of value for our shareholders, but they also meant we understood the market really well. And to do those 200 transactions, our team made around 2,000 offers. So, that's a high activity level and gives us a high understanding of what these assets are worth, and how sellers and buyers are behaving. And so that preparatory work and understanding the market was really important once we came to participating in a larger process. And like I said, we were very disciplined about the quality and strategic fit of the inventory that we were pursuing. And as much as we did 2,000 offers on the smaller transactions, we only participated in one large process. It was very much a rifle shot approach, because we knew exactly what we were after in terms of an asset to pursue, and so that gave us the strategic conviction to proceed, and ultimately, history will judge years from now, but out of the gate here, for several quarters has been an enormously successful outcome for us. Any way you measure it, highly accretive. It's driven our capital efficiency up by 15% year over year. Like I said, doubled the Permian inventory. We negotiated that through the time when the banks were those regional banks were collapsing. So, it was definitely a moment for conviction. And I think if we hadn't have done all that preparatory work, it would have been very difficult to maneuver through that time, because it created opportunity, because commodity prices slid backwards, and we were able to be resilient in that process and take advantage of the situation. And then fast forward to some of the more recent transactions, they've been done at, any way you measure it, twice the cost that we did ours at. So it feels like that level of preparation and conviction served us and our shareholders well.
Speaking of poor advice, sometimes the same analysts that like to beat their chest at family dinner and give you their prognosis on interest rates and where they're headed are the same ones that like to tell you how to run your business or give you their 2 cents. They don't have any skin in the game and never ran a company. How do you insulate yourself from those types, and how do you deal with that aspect of the business?
Yeah, I think it's one of the fundamental characteristics of leadership is to not get blown around in the wind, and to have stability, even when there's, sort of multiple, sort of
noise.
Yeah. But at the same time, maintain an openness to being wrong, right? And so it is a real balance to have that stability, and not get blown around, but also, be willing to entertain, like, hey, maybe there's an idea here I haven't thought of, and that we haven't explored as fully as we need to. And so I think that's all part about building that antifragile kind of business, and creating that, actualizing that strategy is finding that balance, and listening very closely to the signals that are being sent, but also making sure you're cross-referencing that against your own work and our own analysis that we use to inform strategy and create the conviction that I talked about earlier.
Not all signal is of the same quality. Is it become easier to identify higher quality signal, so to speak, when you're looking for feedback and input?
Well, I hope so. Yeah, I hope so. I think we're still mid-game, but I think that's for sure an experiential piece of this, and look, I think one of the things that we do really well at Ovintiv is development, both technical and leadership development. And so in a lot of ways, putting our leaders through opportunities that stress them and test them in broad applications, not just a deep channel of expertise that maybe they kind of grew up in or demonstrated capability in, but to test them in those other settings. I think that serves us well, and has served me well, to try and do that diagnosis that you're talking about. And it's part of the reason why I like being an omnivore for input is it lets you test and evaluate all of those different perspectives against our own worldview. and how we're interpreting the problem. So.
Some of the smartest investors and business leaders in the world are proud of the fact that they like to change their mind in terms of the office location of Ovintiv. Maybe again, you can't talk about it, but do you ever consider coming back to Canada, your home base?
Well, I don't know that I need that stress in my life, but I think one of the things that we look back on that and we think about, obviously caused some irritation on Bay Street, but I think one of the things that's important to know is, we didn't change our business in Canada. We're still, in fact, probably a little bigger today in Canada than we were at the time of that shift back in 2020. Nobody moved. All our staff are very much still in place there. And so, look, I think ultimately that's a piece of paper in my general counsel's office that says Denver instead of Calgary is sort of how I think about it. And we believe we run the business the same way we did before. And so some of these things, the door is kind of a one-way door when you walk through. And so, we're pretty happy with how the business is positioned in terms of both our Canadian and our US staff and business.
Some would say that US well productivity is sometimes a bellwether for the state of the industry. You have eyes across the states. What are you seeing in terms of that nowadays? Is it good, bad?
Yeah. It's what I call the middle inning phase. So if you look at well productivity per foot, so per lateral foot of horizontal, it's essentially flatlined industry-wide across all of the North American basins since 2017, 2018. And so that's actually a long period of time now to have sort of stabilized in at that level. And one of the things that we know is always happening is, our geologists and subsurface experts are actually really good. So we didn't start with the bad stuff, right? Like we started with the best stuff. So in 2017 and 2018, companies like ours and across the industry have been, working their way through that resource pyramid. And so what's happened, and this is why I call it the middle innings, is innovation in completion design and targeting is offsetting any decline or erosion in rock quality that as the industry marches through each of these plays. And that this middle inning period followed an early inning period when innovation was actually dominating and well productivity was getting better, ahead of 2017, 2018. And then, eventually, I think we think it's still a ways out, but eventually the industry gets to a place where that innovation can't overwhelm or can't overcompensate against the rock quality erosion, and probably we'll see productivity per foot start to decline. I think within all of that, there's a fair bit of dispersion again. So if you look at company to company levels, you don't see quite as a smooth a story. There's a lot of more choppiness. And so that's where I think the power of innovation is really critical, and why this culture and expertise piece is going to really matter. Because if you've got a business that's not shrinking its inventory, but actually building it like we've done, and then you've got a team that's capable and proven on innovation and execution, that dispersion in performance, our view is going to start to widen in the coming years, because various portfolios are going to start to run out of the really high quality resource, and then various teams are going to do better or worse jobs on that innovation side of things. And so it's actually going to be a really interesting time to be an investor in the space. And it's difficult for investors, I think, to get a really clear picture of that. But I think the performance will just start to tell the story. If you look at what we've done this year, we've had the highest productivity per foot oil wells in the Midland Basin in the Permian. And that's on the back of some completion design innovation that our team has delivered. And so it's exciting to see some of those inflections start to show up in our performance at a time when, the industry is struggling to hold the line.
U.S. shale revolution was incredible for the energy supply of North American independence, but on the other hand, it scares investors. Nowadays, people are worried that it's just going to go crazy again. Are you seeing that, or are you seeing maybe more of a measured approach to growth from shale?
Yeah, very much so. Very much so a measured approach. I think, that's that transition where that business model of trying to create value through growth is really gone. And you've just seen the industry reset to the strategy of delivering value through returns. And that's showing up in how E&Ps are allocating capital, right? And so, we've chosen to soft guide the 2024 expectations to another year of maintenance level for us. So we're prioritizing and maximizing free cash flow generation as opposed to volume growth. And part of the reason for that is, we're using that free cash flow to both de-lever the business, so reduce debt, but also return cash to our shareholders. And one of the sort of decision points that I talk to our investors about is, if I can create more cash flow per share by buying a share back versus putting an incremental rig in the field, that is a fantastic trade, because the share buyback is essentially riskless.
No risk.
And so, that's the environment that we've been in, and why we've chosen to steer the business into that maximize free cash flow, use that free cash flow to grind down debt, create that resilience for the future, and then also move enterprise value from the debt holder to the equity holder. And then by reducing the denominator of all those per share calculations, we're making the business more valuable to each of our shareholders.
Sounds like buybacks may be the preference now. There's not always a prescription or a formula, but between dividends and buybacks, do you have a preference?
Well, we're value driven, so we're agnostic between the tool to return the cash, and we're just straight value driven. So the way we approach that is, we spend and regularly look at what we think the intrinsic value of our business is. And obviously we look at a variety of future scenarios, and we look at a variety of future commodity price environments to sort of test that. But the mid-cycle price scenario that we've been using is like a $55 WTI, $2.75 NYMEX price, and we run that through our intrinsic value development scenarios. We see a business that's worth a lot more than the way the equity trades today. And that's the signal for us to stay in the buyback mode. And I think, should that change in the future, that's the goal, is to change it in the future, then maybe dividends become the right tool to avoid, particularly in a time when commodity prices are above mid-cycle, you have to be cautious of that pro-cyclicality on the buybacks. And so that's how we think about that, is just pure value motivated.
The benefits of energy development. How much does Ovintiv give back to the North American economy annually? You may not have the number off the top of your head, but from an OPEX perspective or even a CapEx, what does that number look like?
Well, it's billions and billions of dollars for us, between royalties, particularly in Canada, where those royalties are paid to the Crown. In the US, those royalties tend to be paid more to the private mineral owners. But, between royalties, direct employment, between the, OPEX and CapEx that winds up in the economy, fueling service providers and their labor force, to the taxes, income taxes, it's billions of dollars between the two Canadian and US jurisdictions, and in each of the states and provinces that we operate in. So I think that's an underappreciated piece of this industry, is the economic contribution that we're making, and especially at a time when affordability and fiscal solvency or fiscal, I guess, more flexibility is becoming a more pressing concern for both the Canadian government and the U.S. governments here. And so I think that's a rising concern that we hear about from Canadians and Americans, and also I think starting to be more of a topic for policymakers to be cognizant of too, whereas they've been a little back from the edge on thinking about those issues for a little while.
And just for the listener, operating expenses means they reoccur annually every year. So that means that Ovintiv is every year spending billions of dollars just to stay flat in local economies.
Yeah. Our capital budget is around this year. Well, I'll use the 24 number because that's the ongoing one, centered at $2.3 billion. So that's just the capital alone. And then, on the operating side, multiples of that. So, it's a big contribution.
Well, that's almost an hour. I
Wow.
think we could go for quite some time, but
yeah, for sure.
Maybe we'll couple more questions and wrap it
Sure.
up there.
I'll go lightning round for you. Yeah.
Well, high grade.
Sure.
As the CEO of a billion-dollar enterprise, it's easy to be busy at times. What do you find the best use of your time is to create value or be productive, however you want to state it?
Yeah, well, so one of the things I do, I think it's an important piece of discipline, is I actually try and episodically, I don't do it super frequently, but I take a look in at how am I spending my time. And one of the we've been working on, or at least I've been working on, a list of things that I think myself and our executive team need to do really well in order to be successful. And so right now the list is like 8 items long. So it's at some point it becomes so big you don't have priorities anymore. But I think they're all pretty real. So the first one is we really work on ensuring we can execute our work safely. That is a huge priority for us, and really pleased with how we've been able to drive safety into our business and ensure that what we do every day, the both direct staff, but also all of the thousands of service providers that are on our work sites every day, go home safely. And then, we have to declare purpose. I think in today's world, that's an underappreciated piece. I think from a culture and an attachment perspective, our staff need to strongly identify with why are we here? Why are we trying to do what we do? And, I talked at the outset on our purposes. We make modern life possible. And then, of course, we got to formulate, set, and communicate strategy. And that's a huge part of what we do. We got to build culture. We talked about that at length. We got to manage performance, because a lot of this is, where are the numbers at? This is what we set as the expectation. How are we performing against that? Got to develop leaders. We got to allocate capital, which is a lot of, how we create value in this business, is allocating capital well. That's actually the third of the 3 strategic ingredients, is allocating capital in a way that drives return at the bottom line. And then finally, we've got to manage risk. And that's just the reality of any business, but it's particularly acute in the world that we live in, where you have commodity price risk, you got regulatory risk, you got operational execution risk. It's just a reality of upstream oil and gas. And so one of the things I've done is, how am I spending my time? If those are the 8 things that I want to accomplish in our business, how does my time line up against that? And what I found is I spent about half my time on 3 big activities. So I'll call it broadly decision-making, working with the board, and then with investors. And then the other half of my time split between 5 sort of things. So they're kind of about 10% each. And so strategy, leadership, driving performance, so that creating innovation, policy and regulatory, because that has a huge overprint on what we do, and then getting those external inputs. We talked about some of those relationships and conversations, so spending time outside the company. So that's kind of how I divide it into those two hemispheres, if you will, of tasks and time spent. So that helps me keep a little discipline on what to say yes to and what to say no to.
Speaking of why you're here, the purpose of Ovintiv is to make money as a company. That's the idea. There's nothing wrong with taking care of the environment, but from an ESG perspective, are you seeing a shift back towards maybe more of a concern on traditional business earning money and generating returns for investors? Are you seeing a shift in that sense nowadays?
For sure. And I think it's a narrative thing, Trevor. I think the narrative got very loud several years ago on ESG and expectations for companies to be participating on these, and ESG has always been this sort of awkward bundle of disparate things anyway. But it was, 80% E, and the E was stood for emissions. And so I think we've definitely seen a rationalization of that. And like you said, a recognition that real sustainability means sustainability of the business. And that doesn't take anything away from what we do in the communities that we operate in, how we perform environmentally, or how we create opportunity for people that join our organization or may want to someday in the future join our organization. All of those things are inextricably linked with making money. Because if we do a bad job of any of those things, we won't make money for our shareholders. So there is a strong linkage, but I think the narrative has gotten much more rational. And world events have driven that rationality, but I think also that pendulum was always destined to swing back.
Well, that's an hour. Maybe
Great.
just to wrap things up, advice. What would you tell a young person entering the energy industry or starting out in business in general?
Yeah. Well, I mean, it's a great question. I get that question a fair bit. I think the list of things that I often tell folks are pretty simple, right? So I think one, be proud of what we do. I think this is one of the most moral things to do in the world, is to create reliable, safe, and affordable energy. And it does underpin everything, every part of our modern lives. And it underpins a lot of the potential for wealth creation for what I think, you had Arjun Murti on the show, and I love how Arjun characterizes this, right? We've got the lucky billion that enjoy the standard of living that we do, and then the other 7 billion that aspire to that. And affordable, safe, and reliable energy is paramount to that progress. So I think be proud of that. I think also I think mentorship is huge. So I always tell young folks, network your way to a mentor. Like, I have rarely seen somebody, when asked, deny a potential protege, right? It's pretty rare for somebody to say, like, no, I'm sorry, I don't have time, I'm not interested in helping you. That is unlikely to happen. So be unafraid to network your way to a mentor. I think again, I'm going to steal from Mike McAllister again, but eat everything on your plate, and demonstrate initiative. And lots of times I think everybody wants to have steak and potatoes, and you might need to start with some broccoli and cauliflower first and show competency and initiative, and then good things come your way. I think spend time in the field. We talked about that earlier on. You just, regardless of what business you're in, getting to the work face is remarkably important, whether you're in a technical or commercial type role. And then I think, I like to say, let the dots connect themselves. That's certainly my career experiences. I could have never anticipated how some of the disparate roles that I had over the years would have led to the next thing. There was just, no way you could have connected those dots ahead of time. So you got to be a little patient and just let the dots connect themselves, and be unafraid to explore some job opportunities that maybe are outside of the norm. And then, I think this idea of being relentlessly curious and seeking out context and asking people, why did you decide to do that? Like, what was your decision process? And, the conversations that you have with your guests on the show, I think are amazing examples of that, where, you hear all these like great nuggets from these really successful business leaders and people in our community that are really, really informative.
Well, thank you for listening.
Yeah, appreciate it.
That is more or less the conversation. I really appreciate your time.
Great.
I know the listeners will also really appreciate it. So thank you very much.
Thank you, Trevor. Yeah, appreciate what you're doing.
We can end the formal conversation there.
Great.
Thanks a lot.